All right, and we are recording this session now. Welcome, everyone. Today is Sunday, May 5th. We are doing this a week earlier than we normally would because next weekend is graduation. If any of you or any of your friends are graduating, congratulations. Meanwhile, let's talk about exchange rates.
Thank you, Vlad, and thank you for the rest of you for joining us. And we want to know why the dollar is rising lately and what problems does it cause or what are the implications. So there's a reading that we had suggested for this from last week's The Economist. And then we're going to, in fact, Vlad is going to be discussing the sliding situation of the yen. And there were two articles that we suggested. So let me start by going over what's happening with the dollar. And in order to do that, let's take a look at the change of the value of other currencies relative to the dollar. And as you can see here, almost all major currencies have lost value relative to the dollar, especially the yen, but the Canadian dollar, euro, British pound, etc. So the dollar is gaining strength. Why is that so, and what are the implications? So why is the dollar strong, and why that's a problem? Let me first start with a bit of theoretical background. We've discussed this in our sessions, but we thought that it may be a good idea to review the theory, which is really interesting theory and very simple in the end, simple idea that gives you a lot of insight. So in case you're very familiar with this, please forgive me for repeating something that you're familiar with, but let's make sure that we're all on the same wavelength. Now, there's a typo here that should be interest parity condition, which I want to discuss. And first, let's look at variables that we're going to be using. There are essentially four variables. One is the current exchange rate. The other variable is expected exchange rate, what we expect the exchange rate to be in the future, for example, a year from now. The two variables are interest rates, domestically and in the rest of the world or foreign country. So those are the four variables, E and I. Now, in order to develop a theory of how the exchange rate is determined in the market, let's start looking at what an individual would do with their money if they have domestic currency H and they want to get some foreign currency a year from now. They can exchange it in the future, keep the money in the form of home currency H for 1 year, and then earn interest I on it for 1 year, and then turn it into foreign currency. So the total if you have 1 unit of domestic currency, you're going to have 1 plus I domestic currency next year. And the fact that you expect the exchange rate to be EE, that's how many foreign currency units you can buy with 1 unit of domestic currency. The total foreign currency units that you will have is 1 plus I times E, EE. Now, if you have another option, you can actually turn your money into foreign currency right now and keep it in foreign currency form and earn interest on it in foreign currency. So what you will have at the end of the year is E foreign currency units that you have right now times 1 plus I star, which is principal plus interest on foreign currency. So these two are the two payoffs from the two different strategies. One is the strategy of keeping domestic currency. The other one is keeping foreign currency. Now, suppose that expected exchange rate and interest rates are given. We want to know what would happen in the market if the payoff from holding domestic currency is bigger than the payoff from holding foreign currency. Remember that if you keep it in domestic currency, you earn interest I. So the left-hand side of this inequality would be the payoff from keeping domestic currency. The right-hand side is the payoff from keeping foreign currency. If the left-hand side is bigger, you would like to hold domestic currency. Everybody wants to hold domestic currency. So what will happen as a result of this is that our currency, our home currency in the spot market right now, because everybody wants to hold it, it's going to gain value. It's going to appreciate. And as a result, the whole right-hand side will go up. The opposite happens if the inequality is reversed. If the payoff from holding domestic currency is less than the payoff from holding foreign currency, people would want to keep foreign currency, and as a result, our currency starts depreciating, and the whole right-hand side will go down. So notice that every time there's an inequality, there's going to be a movement in the exchange rate. Equilibrium will be arrived at when the two sides are equal to each other and there's no motive for or factor that makes the exchange rate change. So in equilibrium, the two sides must be equal to each other. This is the fundamental equation that tells us how the exchange rate is determined in the foreign exchange market. And it has extremely interesting implications. This is called the interest parity condition or uncovered interest parity condition. You might ask why we have the word uncovered there. That's because there's another option that you may actually be able to buy foreign currency in the future, signing a contract right now, a forward contract, and therefore buy insurance, in other words. So that's called covered interest parity. That's another story. I'm just going to focus on interest parity condition that you see here. So this is the basic form of interest parity condition, and those are the four variables defined. Now, what does this say? It says that if something happens that people in the market, for example, feel that in the future, because of some event that is forthcoming, we feel that the exchange rate is going to appreciate. So let's suppose that EE goes up. Automatically, then, given interest rates in domestic market and foreign markets, the exchange rate will currently go up proportionately. So if you think that something is going to happen 6 months from now or a year from now that will make the exchange rate appreciate, then the spot exchange rate right now proportionately goes up, which is very interesting because think about this. Suppose that you think that interest rates a year from now will be higher. So you expect the currency domestic currency to be valued more than the foreign currency as a result of that increase in the interest rate in the future. Notice here, if the expected exchange rate is given, and foreign interest rate is also given, and our domestic interest rate goes up, that will also cause our spot exchange rate to appreciate. So if the Fed, for example, is expected to raise interest rates or not to lower them in the future, so it turns out to be higher than people used to expect, as a result, our exchange rate in the future is expected to rise. Right now, what will happen in the market, even if the Fed does not change the interest rate, if people think that the Fed will increase interest rates in the future, that will make EE go up, and that will lead to appreciation right now. And that's exactly what's happening right now. I'm going to come back to this in a moment, but there's a little bit of detail that I need to add here before we go further, because this could be a question that comes up. What about risk? because so far I did not talk about any risk. And those interest rates, by the way, that we have here, I star and I, are risk-free interest rates. If the interest rate is inclusive of rent is in the domestic market is IR, and rho is our risk premium, then the risk-free interest rate is I equal to IR minus rho. And similarly for the foreign market, interest rate in the foreign market, I star, is the risk inclusive of the nominal interest rate, IR star, minus any risk that exists in the bond market of the foreign country, rho star, risk premium. So actually replace this I and I star in the IP condition, in the interest parity condition, and put the amount equivalent in this relationship, and one gets this, which says that if for example, given the expected exchange rate, given whatever we think is going to happen in the future, given foreign interest rate, given domestic interest rate, in nominal interest rate, inclusive of risk, given those things, then let's say the risk in our market, in our country goes up. Bonds become risky in our country. Then rho goes up, everything else is unchanged. That lowers the right-hand side, and then the left-hand side must also go down. And for that to happen, E has to depreciate. That's the one way of using this equation, adding risk issues to the interest parity condition. Or, for example, if risk in the foreign market goes up, then the first parenthesis in the left-hand side goes down, and in order for the two sides to remain equal, E needs to go up. So if foreign risk goes up, our currency appreciates. The foreign currency depreciates. Now, interest rates have been rising in the US. This graph shows the interest rate, two-year government bond yield, which is the one way of looking at the long-term or medium-term interest rates. And as you can see here, interest rate in Japan has gone up slightly. In Germany also has gone up slightly. In China, it has gone down. And in the US has gone up more than it has gone up in Europe and Japan. And that's really the cause of the dollar gaining value. People think that given the high inflation in the US and strong growth, the Fed will not lower interest rates as people had expected before. And because of that, they're abandoning the idea that the dollar is going to be lower in the future because interest rates are going to go down in the US. And because of that revision, the dollar is expected to rise in the future because interest rates will continue to be high. So that's the basic idea. So the Fed is unlikely to cut interest rates anytime soon. That's what has dawned on everybody in the stock market and the US economy. And growth in the US has been relatively strong, although we are getting some signs of slowdown, especially the labor market was relatively weak, the information that came out this week. And the other reason why the dollar may actually strengthen in the future is that the US politicians want to promote manufacturing in the US. There are a couple of tools that they're using. One is protectionism, which preventing competitors from other countries to come in. And that we know that is going to increase the value of domestic currency, because that's a bit involved why protection may increase the value of the currency. But if you would like, I can get into that, but I just stated as a result that we know in economics that protection increases the value of domestic currency and makes it difficult to export, although protection makes it difficult to import. At the same time, it has an anti-export effect. The other mechanism that US politicians use and Biden administration right now is using is fiscal support. You actually try to subsidize domestic industry. What that does is that it increases expenditure, overall demand goes up, and that high demand leads to higher growth and higher inflation. The response of the Fed to that has to be low, keeping interest rates high to prevent inflation from taking off or reviving. So in the past few years, US economy has grown much faster than those of its major trade partners, Japan, Germany, France, Britain, and also faster than many other countries. And higher growth keeps interest rates elevated, strengthens the dollar. The US products are becoming more expensive as a result of this, because the dollar going up, it means that if somebody from the rest of the world wants to buy American goods, they have to use more of their money to buy the dollar needed to buy US manufactured products. And this is going against manufacturing growth, which was the initial intent of politicians. So US politicians are actually trying to get the dollar to weaken, but their policies are doing the exact opposite. By protectionism and subsidization of industry, they are promoting a strong dollar, but they realize that that works against the aim of promoting manufacturing, and therefore there are efforts right now going on to try to get US trade partners to do something about this and weaken the dollar. Now, sorry, I think I already have gone over this part. Other countries benefit from depreciation of the dollar, of their currencies. If the dollar becomes stronger, other countries can actually export and compete with US products a lot more effectively. But there's another problem for the rest of the world, that borrowing in dollars, especially the companies that have borrowed in dollars in the past, will find it difficult to pay back their debt if the dollar is strong, because they have to use other currencies to buy the dollar to pay off their debt. Also, trade financing, any money that you need to borrow in order to trade becomes expensive if the dollar is expensive. Most of world trade is done and transactions are done in dollars. So this is what other countries face, the problem that they face, and therefore they also have some interest in letting the dollar or preventing the dollar from appreciating too much. Some countries may be willing to sell their dollar reserves. So many countries have major dollar reserves, like, for example, China has a couple of $trillion of reserves. Taiwan has $500 billion of reserves, and Saudi Arabia, for example, has again close to $500 billion of reserves. So many countries have huge amounts of reserves, and they may be willing to sell those things to buy their own assets to lower the value of the dollar temporarily. But that doesn't work in the long run. And besides, countries like China, they're not going to be cooperating. Sorry again about the typo here. There are tensions between the US and China and some other countries right now, and that doesn't help the US, because those countries will not going to be using their reserves to help the dollar or prevent the dollar from gaining or appreciating. So to conclude, let me just say that what we have is a situation where the US dollar is gaining strength because of the prospects of the US economy. And that's not in many countries' interest. So the US politicians, as well as governments, some governments in the rest of the world, are trying to weaken or prevent the dollar from gaining any further value. But it's not very clear that that's going to work. And the reason is that the US growth remains strong, and political views and attitudes in the US is in favor of protectionism, some subsidization of industry, and some other countries, especially China, which is the most important player in this, are not going to be cooperating with the US to prevent the dollar from gaining value. Any questions? Would be glad to answer questions. Okay.
So there's a question in the chat about the relationship between the strong US dollar and the prices of gold. Is there one?
There is some, but the gold is really gaining value in terms of the dollar, because that's what the issue is. The dollar is gaining value, and the gold is gaining value in terms of the dollars. The price in dollars going up. That is due to world tensions. That's due to those risk factors that I mentioned, the rho and rho star in the equation that I showed.
Mm-hmm. So that's basically the flight to safety overall. So if gold is appreciating against the dollar, it certainly is going to be appreciating against other currencies that have lost value to the dollar. So that's not something that's dollar specific, but it's just the higher global risks and that flight to the perceived safety of gold.
That is true. There's also some sense that US inflation is going to take much longer to bring down to 2%. And that also has led into demand for gold, because gold is a real asset and may actually maintain its value much better than the US dollar. So that's another reason why why gold is up.
Sorry, may I just go ahead to ask a follow-on question on that?
Sure.
So the price of gold has a relatively small relationship to the price of dollar. Is actually more relevant to the risks or perceived risks. Is that right?
That's correct.
Okay, got it. Thank you.
All right.
I don't know why my mute button is. I do have a question.
Sure.
And I wish I would have actually screen captured it, but there is a part where you're saying that in how politicians are promoting the manufacturing industry, it's creating the opposite effect of. So I guess my question is, we are having such a hard time sourcing different machinery, or for instance, everybody wants an EV bus. And we keep ordering EV buses, and now the lead time on the EV buses is 3 years, where it used to be about 8 months. And there were like 2 companies, I think they were both based in Canada, that could actually manufacture the EV buses. One made the batteries, and I think it's the company that made the batteries that's going bankrupt. So we keep buying these EV buses, we keep putting in orders in, and number one, the price of the EV buses, I think, has gone up by almost 100%, and we cannot source them. So in that sense, we are trying to get manufacturing of basically all EV types of vehicles. School buses, we brought a company to Illinois to manufacture EV school buses. So I guess my question is, it seems that, yeah, okay, like for manufacturing, we wouldn't look attractive to countries outside the United States for purchasing because the dollar is so strong. However, the demand in the US is so high that would it matter for certain industries?
right? Very good example of applying this idea. So what is happening is that the trade tensions, I think that's one of the key factors. Otherwise, China would have been producing and selling a lot more buses, EV buses to the US. But because of the tensions, there are limits on how much they can export, and the cost of exporting is high. And they're also afraid of future retaliation by the US. They don't want to provoke US politicians any further by selling their goods here. The yuan has lost value relative to the dollar, if I remember correctly, in the order of something like 6%, 7% in the past few months. And that makes Chinese goods more attractive. But then that's also provoking US Congress to come up with more sanctions or more limitations on trade. And that's why probably a lot of producers who could have delivered the buses are not in that business. They know that by the time the buses are ready to import into the US, something is going to happen and prevent them from delivering.
Right. But so I think in that the US is trying to promote the manufacturing of these buses in the US. It's
Exactly.
kind of to hedge against that. And they're providing all these incentives for people to buy EV cars, and they have to be made in the US. Now a lot of the parts have to be made in the US.
And the US cost goes up so sharply. Again, you had the perfect example of EV buses have doubled in price as a result of this whole policy and whole situation.
And so this sounds like this is a bit of the unintended consequence of the policy, right? Because essentially, and we've seen that quite a bit, I think, in terms of consumer electric cars, those programs that had been instituted to give tax credit. I mean, question how much of those subsidies are actually being captured by the producers versus the consumers, right? That's your classic, tax or subsidy incidence question. And
Right.
what we've seen very often is that when manufacturing capacity is pretty limited, the moment the incentive, the subsidy goes on, the prices simply rise by the amount of the incentive, or you're being forced to sign off the rights to claim this incentive, and doesn't work quite as intended, only contributes to rising prices.
Yeah.
Yeah.
All right, shall we move to yen?
All right, let's talk about Japan a little bit more. So let me share my screen. Here we go. Hopefully you can see the screen okay. So the yen to US dollar exchange rate had been quite a bit of a wild ride, right? If you look at this, sort of over the past, I think this is the past 10 years or so, you're starting somewhere around a little more than 100 yen per dollar. And if you look at this time at the end of April, beginning of March, we are actually pushing a lot closer to 160 yen per dollar, which is quite an incredible depreciation of yen, right? And so this was discussed in those couple of articles on The Economist. The graphs themselves are from Federal Reserve economic data, the economist's favorite source of information. And so we've basically seen a depreciation of roughly 35% vis-a-vis the dollar, right? And the volatility had been pretty significant as well. And the question is, why is this the case? Well, Hadi presented the model to you. And so this exactly conforms to the findings of this model. If we have an increasing gap in interest rates between the Japan and the United States, Japanese interest rates keep staying the same, United States interest rates keep going up, what we're going to see is the depreciation of the yen. And in Japan, the interest rates had been around zero for a very, very long time. Actually, they made it from the negative territory and into the positive territory in March of 24, which is not necessarily something to write home about, while the short-term dollar rates had been around 5.3% since summer of 2023, right, when the rates have been increased for the last time. And what we see is a classic example of the arbitrage process in which investors engage. As the interest rates in the US go up, demand for dollar, sorry, this should have been increases. Let me fix this very quickly and just share that. So demand for dollar essentially increases, demand for the yen decreases, and as a result, the yen depreciates as the theory would have predicted. So, all right, what's going on with my presentation? It's not advancing for some reason. Let me try to reshare that again and see if it's going to get any better. All right, let's see if we actually will advance to the next slide. Oh, I don't know what's going on. Okay. Oh, all right, sorry, forgive our technical difficulties here. Let me see if I can push this here and if that's going to be a little bit better. And so this is an illustration of those two interest rates for the last 5 years, one against the other. You can kind of see how the United States interest rates went up and stabilized right here around summer of 2023. Japanese interest rates had been kind of in the negative territory for most of this time, and only recently they went up into the positive territory. And if we're asking ourselves, why is this taking place? The short answer is really inflation and outlook for inflation, or the expectations for future inflation, right? What we've seen in Japan is that inflation had been extremely low for the past 40 years, which is quite a long time. The inflation outlook remains quite low for the future. And even after the pandemic, or in the pandemic's aftermath, where in nearly all countries inflation rates increased, in Japan they increased too, but by not quite as much, right? The difference is not quite as drastic as it used to be. There's a few explanations for that. So first of all, there are government price controls for utilities and for commodities. So when those rise, they tend to rise fairly slowly and over an extended period of time to avoid short-term swings. Japan was also very careful, very slow in lifting the pandemic restrictions. And you can even think about that as kind of the restrictions on travel, because it was impossible for foreigners to essentially enter Japan for a very long time, at least more than a year, I think, since everybody else removed their controls on movement of people. And you also have the persistent issue of a very weak domestic demand for goods and services. And the explanations in here, one of the explanations might be, sourced in the role of the unions in Japan, because generally what you have is a lot of jobs. I think close to 1/3 of all jobs are actually part-time jobs in Japan. So if you want to, sort of unions don't have as much negotiating power given the presence of those part-time jobs and the reliance on part-time hiring. And so for the unions, when they negotiate with the employers, they will typically prioritize job security rather than increases in pay, right? So if the company tells you, oh, sort of we have to restrict our full-time hiring, or we have to decrease our full-time hiring or terminate people, the unions will rather accept lack of increases in pay, but prioritize that job security a lot more. And of course, here's the elephant in the room, which is the aging population. And the aging population for Japan, Japan is probably one of the countries where the average age compared to the rest of the world is one of the highest, right? People are living a lot longer past retirement. And typically as that takes place, and as people, want to stretch their lifetime savings longer, they're probably not going to be increasing their demand for goods and services very much, rather than anything that's a considerable pressure on that demand, right? And it's a pressure downward. Okay. The fun part is my presentation still is not advancing quite as supposed to, so I'm gonna have to do it like this. The short-term volatility in exchange rates we're seeing, government intervention in the market taking place. The Bank of Japan sells its foreign currency reserves to essentially prop up demand for yen and, prop up its value as much as it can. And it spent a good amount of money from its foreign currency reserves. It probably spent about $60 billion in 2022. It looks like the country is the Bank of Japan is entering the market again in May 2024 as it tries to drive down the exchange rate from 160 yen per dollar to something that's a little lower. And so the estimates are that the Bank of Japan probably spent close to $60 billion again during this month. But will it really help? The answer is probably no, and especially not in the long run, right? You can't really push too much against the economic fundamentals. And the question remains, why is the Bank of Japan doing this? Why is it defending the yen and spending so much money on it? And by the way, just to give you a sense of how large that $60 billion is, if you basically look at the spending in 22 and spending in 2024, sort of just from those two numbers, that's about 120 billion yen. So by my calculations, that's roughly 10% of Japan's foreign currency reserves. And so the limitation in here is that, there is still a lot of room left there. There's still somewhere about 1.2, 1.3 trillion in foreign exchange reserves that the Bank of Japan is holding. But it can only take you this far, right? And you don't want to continue spending where you're basically exhausting the reserves too much. So the spending still has to be fairly measured. So coming back to the issue why Japan is doing that, there's a couple of explanations in here. One of them is a political explanation. So even though there are price controls on commodities and people may not see those increases in prices right away, but given that Japan buys its energy from abroad, if the yen gets cheaper, that means that the energy prices are going to be higher, and initially they'll hurt the energy companies, right? But that pain is still going to propagate to the consumers too. And sort of another potential explanation, probably a little less quantifiable, it's a national pride. So having a currency that swings wildly in its value probably is not necessarily the greatest thing. And so that is another explanation for that defense of the yen, right? And so I think that's actually pretty much it for me. I think I've gone through what I wanted to present. Let me just double check my slide and my slides, and my apologies for all of this back and forth. Yeah, I think that's all that I wanted to talk about today.
Vlad, I have a question. Is it that they want to make the yen or prevent the yen from depreciating, or are they concerned that they may lose control over the slide of the yen?
Yeah,
they may not worry about the yen being depreciated, but if it suddenly starts depreciating very quickly and gets out of hand.
I think that's probably, thank you, Hadi. This is a good question. So I think it's probably, sort of what we've seen in terms of the intervention pattern is probably more consistent with trying to avoid swings and, preventing, sort of that barrier where, sort of the rest of the world will become convinced that the yen is starting to depreciate very fast, right? And that might crash the value of the yen more. But, based on how the exchange rates look like, those interventions don't seem to be helping too much, right? If anything, it probably was, sort of towards 2023, the American exchange rates had stabilized somewhat, right? And we've seen decreases, and we've seen mortgage rates go below, 6%, and sort of those, of course, were driven are tightly related to the 10-year Treasury bond yields, right? 10 years, a little under 10 years is probably the average amount of time that a person holds mortgage. I think it might be closer to 9 years due to refinancing and due to things like that. It seems like, sort of that intervention isn't helping all that much. If anything else, it's the it's the change in the US interest rates that help Japan more. On the other hand, it seems like that the Bank of Japan certainly is not willing to increase the interest rates, right? It's extremely concerned about the relatively weak domestic demand, and that's a trade-off that they're willing to accept as of now.
Thank you.
Mhm.
There are a couple of questions in the chat.
All right, so let me see if I can find the chat questions. All right, Ahmed, do you want to ask your question live?
Yeah, thank you, Professor Vlad and Professor Hadi. Yeah, so I'm thinking when the yen depreciated, maybe this will be advantage for any manufacturing country like Japan.
Mhm.
So its product will be attractive for other countries.
Yeah, it certainly does help the exports quite a bit too, right? So from this perspective, it certainly is useful. And for the country, and sort of for the companies that manufacture in Japan, sort of that will likely help them increase their exports as well, right? And so Toyota and Honda, even though Toyota and Honda, keep in mind that sort of when you were driving a car with a Japanese marquee, right? It's not necessarily a car that had been made in Japan. If you're looking at the SUVs are largely made in the United States, right? They could be put together. There could be a significant amount of ingredients from Japan or components from Japan. But generally speaking, I think even Toyota and Honda and a lot of Japanese car makers, they already have moved some of their manufacturing abroad just because manufacturing in Japan was not quite as competitive. And there is some hope too that this is going to help the manufacturing competitiveness. And if it does, that's kind of your automatic stabilizer of sorts, right? That helps prevent the slide in the Japanese yen because of that.
So in the long term, I am not aware about how much the percentage of export from the GDP. In long term, this will be like something beneficial for Japan or?
Well, yeah, from that perspective, so that, sort of you have two things going on. So number one, sort of if you're looking, number one is that, sure, sort of the price of Japanese exports to other countries is falling, right? Sort of that should help prop up the demand. But on the other hand, what you also have is a relatively significant increase in the prices of energy, which is an input into those manufacturing processes. So you can still expect the costs to be impacted as well. Even if you're still doing well on the revenue side, you're still going to have your costs increase as well because of that energy issue, even though hopefully that increase in cost is not going to be quite as pronounced as the increase in revenue from the higher demand for Japanese goods and services abroad.
Yeah, I got it. Yeah, thank you. It's like a very complex situation.
Well, that's the issue in macroeconomics, right? Macroeconomics is a more difficult course than microeconomics is. There are so many things that change simultaneously at the same time, and all we could do is kind of gather empirical evidence on the exact magnitude of change to see, which of the effects is going to overtake the others.
Correct. Yeah, thank you, Professor.
Okay, great.
Professor, I have a question about that equation Professor Hadi shared in his slides. If I understand it correctly, and correct me if I'm mistaken, that one of the so if the interest rate in US is increasing, does it mean that the dollar will become stronger? Is that, or
Hadi, do you want to take this one?
That's of course conditional on expectations. For example, given the expectations about the future of the exchange rate, right now, if interest rate goes up, the dollar will appreciate right now.
okay.
But if, for example, the expectation is that not only interest rate is going to be higher right now, but also in the future, that will make the future exchange rate also appreciate. And that makes the sort of double effects that makes the currency, the US dollar, to appreciate even more. It all depends on what happens elsewhere. So conditional on foreign interest rate and expectations, if domestic interest rate goes up, we will see an appreciation.
And so Hadi, based on that, so, for example, I think the expectations more or less are now converging on the idea that the interest rates in the United States will stay higher for a while, right? And what that does is that it props up the dollar even more in that self-reinforcing process, correct?
Exactly. That's towards the end of last year, 2023, there was this view that the Fed will have to lower interest rates starting March. Then they pushed it back to June. But right now, the expectation is that if there's any lowering of interest rate, that's November. And some observers are saying that may actually take longer, and maybe we should just get used to these interest rates, which is, by the way, historically still is not very high. So, for example, you can get mortgages 7%, and that's, if you look at history of mortgage rates in the U.S., this past several years were actually anomalous.
We're actually coming closer to the average rate over the long-term period of time, right? So in some sense, the mortgage rate of 2.75%, this was the outlier. It's not the mortgage rates now.
That's not, those interest rates are not going to come back for a long time.
But I think that the challenge for that, the cost of living still increasing with this.
That's true. The inflation still continues at much faster rate than the Fed would like to see, and people feel comfortable about. In fact, that's causing some resentment because workers get their salaries, wages go up, and they think, okay, now I should feel richer. But when they go shopping, they discover that they actually can buy only the same amount that they used to. So the increase is really evaporating. Inflation causes the real values of goods to go up, and relative to wages, people are not really gaining much.
Yeah, so according to the current situation, do you think maybe the Fed even will increase interest rate later of the inflation?
That I think is probably not going to happen in the foreseeable future, because if they just keep the interest rates at the level that they are, the rate they are, this is enough probably to slow down the U.S. economy pretty much. There are other factors also, other things happening that might change these whole set of equations. For example, after the election in the U.S., and my sense is that the U.S. government is going to cut its expenditure, cut its deficit. And if they do that, demand is going to weaken and the economy is going to slow down even further. And that will allow the Fed to lower interest rates beginning end of this year. So, or maybe in March of next year, 2025. So those factors are also important in what might happen down the road.
So that means not once the Fed decrease interest rates, that means the growth will increase. Maybe will take time.
In other words, if the growth slows down as a result of U.S. government cutting its expenditure and deficit, then the Fed will come in to lower interest rates to kind of maintain the pace of growth.
Thank you.
Sure. Lucy had a question on chat.
It wasn't really a question. It's just I had already asked about the impact of the auto industry, but I think that's been answered, that it's mostly American parts for these Japanese cars anyways. But I wonder, I don't know if like the Hyundais and the Kias are made in the US, and if that's going to impact maybe lower prices versus those cars. I'm just, shocked that my minivan died. My Honda minivan died last year, and what I paid $39,000 for back in 2010 is now about $60,000. And it's the same, same model. And I'm wondering, now I see a lot more people driving Kia minivans, and I'm just wondering if it's gonna, if the Japanese yen is holding steady with the whatever the South Korean dollar is, if it would.
One Korean won.
Oh, Korean won, yeah, if that's going to impact that competition, a Korean made versus made car versus a American made but Japanese car.
Well, but it sounds like, I mean, Japan probably had suffered a lot more compared to Korea in terms of that exchange rate. So, and there is still a fair amount of parts that are being made in Japan. So hopefully that will be a positive driver towards, reducing the inflation rate on the Japanese cars, right? Or the cars sold under the Japanese marquee. So there is some hope here, right? So for the won, I think sort of the won has depreciated against the dollar, but certainly not quite as much as the United States, and that does help keep the Korean cars more competitive too. And my sense is that sort of there is more of Korean cars or higher percentage of parts of Korean cars that are actually made in Korea. In South Korea as opposed to the United States. Korean manufacturers have a number of plants in the United States, but they don't rely on them quite as much as Japanese car makers do.
Okay, interesting.
All right. I think it sounds like we're ending the session on time, very close to 2 o'clock.
Great.
So thank you.
So let's just remind everybody that please suggest topics if you would like us to discuss anything that matters for you. So we would be really glad to prepare a session on the topics, macroeconomic topics that interest you most. Thank you.
All right.
Thank you all. Talk to you soon. And tell your friends.
Yeah. Bye.
All right.
Thank you.
Bye all.
We follow your suggestions. Thank you.